want to welcome in Paul Hickey, co-founder Bespoke Investment Group, to give us his insights into this volatile market and where we could be headed. Good afternoon. Good to see you, Paul. Some of your thoughts.
Hey, Nicole, how are you? So, I think, what the market's been contending with lately is whether or not the policies of the Trump administration, the herky-jerky tariff announcements that are on again, off again, will translate into a meaningful economic decline. And there's a real dichotomy in the data between the hard and soft data. So the soft data, like yesterday's consumer confidence report, that came in horribly, and the Michigan confidence has also been very weak. And they're at levels that in many cases would be considered recessionary. So that's the bad news. The good news is that we haven't seen this translate into the hard data as of yet. We saw new home sales, housing starts, building permits in the last week all come in line with or better than expected. Industrial production, capacity utilization, durable goods also better than expected. So we've seen that data come in good. Even jobless claims, where we constantly hear that the Doge cuts are going to cause a pickup in joblessness. They've been better than expected the last 4 weeks, not by a large margin, but they're hardly falling off a cliff at this point. So we haven't quite seen that transfer from the soft to the hard data of weakness, which I think is a good thing.
Right, understood. My concern too was about the earnings, that the earnings season is going to begin and that the CEOs and companies would sort of play it safe and not give any kind of great news ahead, but be a little more conservative, and that could then hurt sentiment further. I don't necessarily love that scenario, but is that a possibility?
Yeah, so we're going to have earnings season come up, and it's starting about 2 weeks here. And so it's interesting because we've seen estimates come in pretty decently because of fears of this slowdown in activity from these tariffs and trade policies. So, but that's in most of the weakness, again, has been in the soft data rather than the hard data. So you have the potential for some surprises coming into earnings season where expectations by anyone you talk to, just as you mentioned, the way I think about it, and when I talk to people, they're not expecting anything positive to come out of this earnings season. So whenever you see that, the bar is set low, and it's all about at the margin. So if we can see results come in better than expected, I think that'll be a positive. There's, like you said, though, there's no incentive for companies to give positive guidance going forward. But if there's not a big uptick in the pace of companies lowering guidance, that's something we could hang our hat on.
And look, if they're somewhat tariff proof, I'm sure they're going to be noting that, if they're more at home here, they'll probably tout something like that. So that could be interesting as we start to hear more and more companies say how the tariffs may or may not affect them. Maybe it won't be as bad as some people think. That could be a bright spot. How about Tesla? What does Tesla signify to you right now in the Tesla story, which has been wild, but has been moving back higher? It's up 11% this week.
Yeah, so it's interesting to look at Tesla, and it's a case in point when you're watching the market. For instance, when you see stocks fail to rally on good news, that's a red flag. So NVIDIA, for the last 6 to 9 months, you've seen multiple periods where there's been good news, stock pops, and then immediately reverses. In the case of Tesla, we've seen a lot of bad news. The stock has declined about 50% from its peak. Earlier this week, you saw that European car sales were down 40% year over year in the first 2 months of the year. That's a staggering decline. And yet the stock was higher that day. So when you start to see stocks start conversely rally on what's bad news or stop going down on bad news, that's a good sign. And what's really fascinating about Tesla is despite that over 40 or 50% decline from the peak, it's still up about 11% since election day. And that means it's outperformed 80% of all S&P 500 stocks since election day. So as bad as the last couple of months have been, it's been a reversal of what was a real, exuberant period post-election. And we're just getting back to resetting things back to a baseline level.
Look, I think it's almost tough for people. They got a little spoiled with over 20% gains 2 years in a row, and then they say, oh, the S&P is down this year, the NASDAQ is down this year. Maybe, I mean, your thoughts for year end. I had a guest on today who had a 6,900 target for the S&P 500 by the end of the year. That was on the higher end of most of the folks that I've been speaking with. Where do you think the S&P could be headed between now and the end of the year, or even a year from now?
Yeah, so I think, like you said, we came into this year back-to-back 20% gains. We saw over 50 new highs in the S&P 500 last year. The S&P never traded below its 200-day moving average for the course of the last year. Those things are very uncommon. And as we wrote our year ahead outlook in the beginning of the year, we said, don't expect those types of gains going forward. We weren't necessarily looking for the sharp types of declines that we've seen, but I think this has helped us to reset sentiment for the rest of the year. Look what we've seen. We've seen one of the fastest 10% corrections from an all-time high on record. The 6 other ones that we've seen in the post-World War II period, where we declined over 10% in the course of a month from an all-time high, the S&P was higher, regained those former highs within 6 months 5 times, and came within 1% within the next 6 months of those former highs the other time. So you do tend to see a snapback, while there could be more volatility in between. And as I just mentioned about sentiment, you look at the consumer confidence report yesterday. Well, 2 things I would notice there is, even though that report was very weak, the jobs plentiful index and the jobs hard to find index, you didn't see any big movements in that. So the labor market hasn't shown deterioration in the last month, according to consumer expectations and perceptions. But you look at stock market sentiment, the percentage of just regular consumers looking for the stock market to decline over the next year increased to 44%. It was one of the largest 1-month increases on record. And think about it, the market usually goes up every year about 75% of the time. So if you're expecting the stock market to decline more than 40% of people are really going against the tide there. And when you look back at those prior periods where we've seen that sharp uptick in negative sentiment on the part of consumers, it's usually been positive. There are about, I think, 8 other times where we've seen similar spikes. 7 out of 8 times we were higher 6 months and a year later. So that kind of sentiment, we've seen such washed out sentiment, it tends to be, things can stay volatile in the short run, but over the next 6 months to a year, it's usually a good sign.
Yeah, it's interesting. And that could be a contrarian indicator, right? I mean, when you start to see more people getting negative. Just a quick thought. I only have seconds. I'd love just a quick response. Cash. Big mistake to sit in cash or put it to work on the pullbacks? What do you do with cash?
I think this is going to be a volatile couple of weeks. And so if you have a little bit of cash here on the big down days that we're likely to see, we're going to see big up days and down days. When you get a big down day, you could use some of that cash to add exposure. We're not saying, dive headfirst into the pool, but, use those as opportunities.
All right. Paul Hickey, co-founder of Bespoke Investment Group. Thank you, Paul. Great to see you. Appreciate it.